Something just happened in the silver market that most investors will not fully understand until it is too late. As of today, Monday, February 16th, 2026, silver has been driven sharply lower in a move that was not random, not accidental, and not organic. It unfolded during one of the thinnest liquidity windows of the entire year, precisely when the least resistance could be exploited. What occurred late Sunday night may prove to be the final positioning event before the March delivery cycle forces a structural confrontation inside the futures system. The next 72 hours are not just another trading period. They may determine whether investors prepare intelligently for what is coming or get shaken out at exactly the wrong moment. Listen carefully, because once you understand the mechanics behind this move, the price action begins to look very different. Sunday evening, February 15th, seemed uneventful across the eastern United States. Families were finishing dinner. Football conversations filled living rooms. Markets appeared quiet. Yet beneath that calm surface, electronic trading systems were preparing for a calculated operation. Two major global holidays had converged to create what professionals refer to as a liquidity vacuum. President's Day, observed on the third Monday of February, meant that American banks, exchanges, and institutional desks would remain closed for 24 hours. At the same time, Lunar New Year celebrations had effectively reduced participation across China, Hong Kong, Singapore, and other Asian financial centers. This rare double holiday alignment does not occur often. Sophisticated participants had identified this weekend months in advance. In markets, timing is rarely coincidence. In this case, it was tactical. Silver had closed the previous Friday at $77.41 per ounce, stabilizing after an extraordinary 12 months that had seen prices surge beyond $120 earlier in 2026. Throughout 2025 and into early 2026, silver captured global attention. Industrial expansion, monetary instability, and speculative participation combined to drive one of the most aggressive advances in modern history. But markets do not move vertically forever. Following the January peak above 120, silver entered a harsh corrective phase. Late entrants were punished, leverage was exposed, conviction was tested, and now, during thin Sunday electronic trading, another decisive chapter unfolded. At exactly 6 p.m. Eastern Standard Time, heavy sell orders struck the futures market. Within minutes, silver fell from 77.41 to 76.32. Under normal trading conditions, such a move might appear minor. But inside a liquidity vacuum, every order carries amplified impact. Selling arrived in carefully structured waves, algorithmically timed to intensify downward momentum while minimizing capital required to achieve maximum visual effect. Professional trading desks describe this strategy as painting the tape. Concentrated selling during low-volume conditions creates the appearance of widespread bearish sentiment. Charts begin flashing red, automated systems react, retail traders panic. By 7:30 p.m. Eastern, silver had touched 75, representing a decline of more than 3% from Friday's close. As of this Monday morning, February 16th, 2026, silver trades near 75.41. For leveraged futures participants, the decline was severe. Positions that appeared secure at the end of the week suddenly faced immediate stress. The CME Group's recent increase in margin requirements to 15% left many traders operating with minimal flexibility. Implemented only weeks ago, the margin hike required significantly more collateral per contract. Those who had maximized exposure found themselves confronting limited choices: wire additional funds, close positions at losses, or face automatic liquidation. But this was Sunday night. Banks were closed. Wire transfers were unavailable. Broker systems operate without emotion. Stop-loss orders began triggering rapidly. Once activated, these protective mechanisms convert into market sell orders, accelerating downward pressure. Understanding this cascade reveals the structural imbalance between institutional participants and retail traders. Large trading desks possess sufficient capital reserves to withstand temporary drawdowns. Retail participants often operate with higher leverage and thinner liquidity cushions. During thin market conditions, that vulnerability becomes amplified. This is not accidental. It is embedded within market structure. Institutions analyze order flow data to identify clusters of retail stop-loss levels around technical areas such as round numbers and prior swing lows. By pushing prices through those zones during low liquidity, cascading liquidations occur. The metal forced out of retail hands is accumulated by better capitalized participants willing to hold patiently. This is not conspiracy. It is documented market microstructure. The Sunday night decline of February 15th, 2026 exhibits all the hallmarks of a coordinated liquidity event. Double holiday timing, algorithmic precision, and deliberate targeting of known support levels. Yet this does not signal long-term weakness. Tactical raids often represent defensive maneuvers by participants confronting structural supply issues. Bullion banks and institutional shorts may influence paper pricing temporarily, but they cannot alter the deeper imbalance between physical supply and industrial demand. Inventories continue tightening. Industrial consumption continues expanding. Every ounce forced out through leveraged liquidation must ultimately be delivered to manufacturers requiring tangible metal. The divergence between paper futures pricing and physical fundamentals grows more pronounced with each passing month. Temporary suppression does not eliminate scarcity. For informed investors, these moments often represent opportunity rather than catastrophe. To fully understand this correction, perspective is essential. Silver's rally beyond 120 earlier in 2026 was described by analysts as parabolic. Parabolic advances occur when price acceleration feeds upon itself. Momentum attracts participation. Participation drives further momentum. Eventually, new entrants chase gains without fully assessing risk. Leverage increases. Profit-taking intensifies. When reversal begins, corrections can be sharp. Silver's decline from 120 to the present 75 range represents approximately a 37% correction. Severe, yes, but historically consistent with retracements following parabolic moves, which frequently fall between 38 and 62% of the prior advance. Current price action suggests silver may be approaching the lower boundary of that historical retracement band. More importantly, the drivers behind the original rally remain intact. Global industrial demand continues expanding, particularly within renewable energy and electric vehicle manufacturing. Mine supply remains constrained by development timelines spanning 7 to 15 years. Recycling growth cannot offset structural deficits. Inflationary pressures persist globally. These forces did not disappear because price corrected. They continue operating beneath the surface, gradually tightening the physical market. The Sunday flush must therefore be interpreted not as structural collapse, but as strategic positioning ahead of the March delivery cycle. What happens next depends not on emotion, but on whether the underlying supply-demand imbalance asserts itself as inventories continue shrinking. The nomination of Kevin Warsh as the next Federal Reserve Chair introduced immediate volatility into an already fragile environment. Markets reacted swiftly. The U.S. dollar strengthened, Treasury yields adjusted, precious metals, including silver, faced renewed pressure. On the surface, the reaction appeared logical. Warsh is widely regarded as hawkish, favoring tighter monetary policy and a more aggressive stance against inflation. But financial history repeatedly demonstrates that central bank leadership often evolves once confronted with fiscal reality. Every modern Federal Reserve Chair entered office with perceived ideological leanings that later bent under systemic pressure. Paul Volcker, remembered for decisive inflation suppression, operated within economic constraints that demanded flexibility. Alan Greenspan, initially viewed as disciplined and hard money-oriented, presided over significant monetary expansion. Ben Bernanke, an academic expert on the Great Depression, implemented unprecedented quantitative easing when systemic stress required intervention. Janet Yellen maintained ultra-low rates longer than critics anticipated. Jerome Powell, initially expected to normalize policy steadily, ultimately oversaw the largest monetary expansion in Federal Reserve history. Institutional realities tend to reshape personal doctrine. Warsh may advocate firmness, but he would inherit structural deficits, record federal debt levels, and a treasury dependent on continuous refinancing. Interest payments on U.S. debt have reached historic proportions, consuming a rising share of federal revenue. Sustained restrictive policy risks intensifying fiscal strain. No Federal Reserve Chair can indefinitely ignore Treasury financing requirements without triggering broader instability. Monetary rhetoric often softens when confronted with debt arithmetic. The dollar's strength following Warsh's nomination contributed to silver's recent correction. A stronger dollar typically pressures commodity prices in the short term. Yet industrial consumption does not pause for currency headlines. Beneath policy speculation, physical demand continues advancing. The Comex silver inventory situation has now entered what analysts describe as the red zone. Registered silver inventories, the category available for physical delivery against futures contracts, have declined to approximately 100 million ounces. This represents a dramatic reduction from previous years when registered inventories exceeded 300 million ounces. The pace of withdrawal has accelerated significantly. January 2026 alone saw nearly 50 million ounces removed from Comex vaults, roughly 4 times the withdrawal rate during the same period the previous year. This is not internal reclassification. The metal is leaving the exchange entirely. It moves into private vaulting systems, industrial supply chains, and offshore destinations beyond paper market circulation. The ratio of paper claims to physical metal has expanded to roughly 8-to-1. For every registered ounce, 8 futures claims exist. While many participants roll contracts without seeking delivery, the vulnerability emerges if even a modest percentage demand physical settlement simultaneously. Force majeure, the legal mechanism allowing exchanges to suspend delivery obligations under extraordinary conditions, has never been declared for Comex silver, but serious market analysts now discuss the concept openly. March 2026 represents a critical delivery cycle. Historically active, March attracts participants who intend to take possession. With inventories depleted and industrial demand elevated, this cycle becomes a structural stress test. Industrial consumption remains the central pillar. Solar panel manufacturing consumes immense quantities of silver within photovoltaic cells. Each gigawatt of installed solar capacity requires approximately 80 tons of silver. Global solar installations continue expanding due to government mandates, corporate sustainability commitments, and improving economics of renewable energy. This demand is structural, not speculative. Electric vehicle production introduces additional pressure. EVs contain substantially more silver than internal combustion vehicles due to electrical systems, battery components, and onboard electronics. As EV adoption accelerates worldwide, automotive silver consumption increases correspondingly. Fifth-generation wireless infrastructure contributes further demand. Advanced networks require components with exceptional conductivity, and silver remains unmatched in electrical efficiency. There is no adequate substitute at scale. Medical devices, water purification systems, and antibacterial applications consume additional quantities. Silver's antimicrobial properties make it irreplaceable in critical healthcare and sanitation contexts. This industrial demand is inelastic. Manufacturers cannot substitute copper or aluminum without compromising performance standards. Meanwhile, the Shanghai Futures Exchange reveals even sharper depletion. Silver inventories there have declined by more than 88% from recent peaks, falling to approximately 342 tons. China's photovoltaic industry, the largest globally, requires massive silver supplies. Its electric vehicle manufacturing sector, also dominant, intensifies domestic consumption. Strategic accumulation by Chinese entities further reduces tradable supply. Metal flowing east frequently does not return to Western exchanges. The simultaneous tightening at Comex and Shanghai creates a global pinch point. Metal previously available for arbitrage between exchanges has effectively disappeared from the tradable float. While much of it remains physically existent, it no longer participates in price discovery. Analyst forecasts reflect these tightening dynamics. Bank of America's Michael Widmer maintains a long-term projection centered around 39 per ounce, based on what he calls the recycling parity price. As accessible deposits decline, unconventional recovery methods such as urban mining require higher prices to become economically viable. Extracting silver from electronic waste and obsolete equipment demands substantial energy, labor, and technological investment. Current pricing between 70 and 100 may remain insufficient to incentivize sustainable long-term supply. J.P. Morgan Global Research provides a more conservative yet still constructive outlook, forecasting an average silver price of 81 per ounce for 2026. Analysts acknowledge that Warsh's nomination and dollar strength contributed to the 27% decline from January peaks. However, they emphasize that this marks the 5th consecutive year of structural supply deficit. The cumulative shortfall over that period has reached approximately 820 million ounces. Such a deficit cannot be replaced quickly. Mine development timelines span 7 to 15 years. Recycling cannot fully bridge the gap. Ultimately, persistent deficit resolves through price adjustment. The widening disconnect between futures pricing and physical acquisition cost further underscores tension. Retail investors purchasing coins and bars face premiums far above historical norms. Dealers report sourcing challenges. Wholesale premiums have expanded even as paper prices declined. When physical premiums rise during futures weakness, it suggests genuine scarcity beneath derivative pricing. Geopolitical uncertainty adds another layer. Ongoing US-Iran nuclear negotiations create instability in the Middle East. Markets traditionally respond to geopolitical stress by favoring precious metals. While dollar strength muted immediate safe haven flows, any escalation could rapidly reverse that dynamic. Silver's dual identity as both industrial input and monetary asset makes it uniquely sensitive to systemic shifts. Its historical role as money across civilizations remains embedded in investor psychology. During periods of uncertainty, that heritage resurfaces. At 75 per ounce, silver remains far below inflation-adjusted equivalents of its 1980 peak, which would translate into several $100s today. Industrial demand now far exceeds levels seen 4 decades ago, yet pricing reflects temporary futures dynamics rather than long-term structural imbalance. As March approaches, the question is no longer whether volatility will occur, but whether delivery mechanics can absorb tightening inventories without visible strain. The larger fiscal backdrop reinforces why this correction must be interpreted within structural context rather than emotional reaction. The United States government continues operating under expanding deficits with no credible trajectory toward contraction. Interest payments on the national debt have reached historic levels, absorbing an increasing share of federal revenue. As rates remain elevated compared to the previous decade, servicing costs compound. Regardless of political leadership, deficit spending persists. This fiscal reality constrains monetary policy far more than public rhetoric suggests. No Federal Reserve chair, regardless of personal preference, can indefinitely maintain aggressively restrictive conditions while Treasury financing needs escalate. Monetary tightening collides directly with debt sustainability. Historically, that collision resolves through accommodation. Inflation, though moderated from crisis peaks, remains structurally elevated compared to the pre-pandemic era. Energy transition investment, reshoring initiatives, supply chain fragmentation, and demographic labor pressures all sustain upward cost momentum. These are not short-term distortions. They represent multi-year structural shifts. Silver's role as an inflation hedge may not be its primary driver, but it provides additional long-term support within this macro environment. Temporary price declines do not alter the arithmetic of persistent deficit spending combined with structural inflationary forces. March 2026 now stands as the next decisive checkpoint. Delivery months reveal whether futures pricing mechanisms can function smoothly when physical demand intensifies. Registered Comex inventories sit near 100 million ounces. Paper claims hover around 8 times that amount. Industrial users observing tightening supply conditions may accelerate delivery intentions rather than risk procurement disruption. Even modest increases in delivery demand could expose fragility. Force majeure remains improbable, but no longer dismissed as impossible. Should delivery complications emerge, the divergence between paper futures pricing and physical valuation could widen rapidly. Futures contracts derive legitimacy from the assumption that metal can be delivered when requested. If confidence in that mechanism weakens, repricing occurs. Bullion banks maintaining substantial short positions face elevated sensitivity during this period. Their strategies rely on orderly delivery cycles and predictable rollover behavior. The Sunday evening flush on February 15th must be interpreted in this broader framework. Forcing leveraged long participants to liquidate ahead of the March cycle reduces potential delivery obligations. Each contract closed under margin stress represents one less physical claim to satisfy. The 75 price level, therefore, should be understood as a tactical outcome rather than structural equilibrium. It reflects temporary success in exploiting low liquidity conditions during a rare double holiday overlap. Once full market participation resumes and liquidity normalizes, underlying imbalances remain unresolved. Physical silver cannot be created through derivatives. It must be mined, recycled, or transferred from existing holders. Mine development requires 7 to 15 years from discovery to production. Recycling growth cannot compensate for cumulative deficits approaching 820 million ounces over 5 consecutive years. Industrial consumption continues expanding. Solar installations scale annually. Each gigawatt requires approximately 80 tons of silver. Electric vehicle production increases global automotive demand. Advanced electronics and fifth-generation infrastructure depend on silver's unmatched conductivity. Medical and antibacterial applications require its unique properties. These consumption channels are not speculative. They are structural and ongoing. Unlike investment flows, industrial demand is inelastic. Manufacturers cannot delay production indefinitely due to short-term futures weakness. They must secure supply regardless of paper volatility. This persistent baseline demand creates underlying tension beneath surface price action. Geopolitical uncertainty remains another variable. U.S.-Iran nuclear negotiations continue introducing regional instability risk. Historically, precious metals attract safe haven flows during geopolitical escalation. While dollar strength following Warsh's nomination suppressed immediate momentum, currency dynamics can shift quickly under stress conditions. Silver's historical identity as money spanning thousands of years continues influencing investor psychology. During systemic uncertainty, that monetary heritage resurfaces. Though modern markets classify silver primarily as industrial, its monetary memory persists. From a historical perspective, silver at 75 per ounce remains dramatically below inflation-adjusted equivalents of the 1980 peak, which would correspond to several $100s in today's purchasing power. Industrial demand today vastly exceeds anything present 4 decades ago. Renewable energy, electric mobility, and advanced electronics did not represent significant consumption drivers in 1980. Yet current pricing does not reflect that expansion. JP Morgan's forecast of an 81 average price for 2026 implies recovery from present levels. Bank of America's long-term recycling parity framework suggests higher equilibrium may eventually be required to incentivize sustainable supply development. These projections derive from structural analysis rather than speculative enthusiasm. The widening disconnect between paper futures pricing and retail physical premiums provides real-time evidence of scarcity beneath derivative layers. Coin and bar premiums remain elevated despite futures weakness. Dealers report sourcing constraints. When physical markets command higher premiums while futures decline, historical precedent suggests eventual convergence occurs through paper repricing upward. Technical analysts continue monitoring the 75 to 77 region as critical support. Fibonacci retracement levels from the 120 peak converge within this band. Moving averages and previous consolidation zones intersect here. Sunday's gap lower during thin liquidity often functions as a magnet for short-term recovery once normal depth returns. A rebound towards 77.41 would not conclude the broader correction, but it would signal exhaustion of forced selling pressure. Beyond technicals and headlines lies a fundamental constraint. Available silver supply remains finite in the short term. Each withdrawal from Comex vaults reduces deliverable inventory. Each ton absorbed by Shanghai or industrial end users reduces tradable float. Structural deficits accumulate annually. The coming March delivery cycle will reveal whether current mechanisms can accommodate tightening without visible disruption. Smooth execution would temporarily restore confidence. Visible strain would accelerate divergence between paper and physical markets. Either outcome unfolds against a backdrop of persistent supply imbalance. Retail investors possess one structural advantage unavailable to leveraged institutional traders: the capacity for patience. Institutions can influence short-term pricing during engineered liquidity windows. They cannot override geological scarcity or industrial necessity. Physical metal required by industry must ultimately be sourced from diminishing inventories. The events of February 15th and 16th, 2026 represent a tactical episode within a larger structural narrative. The correction from 120 to 75 reflects natural retracement amplified by strategic timing during a double holiday liquidity vacuum. It does not negate multi-year deficits, accelerating industrial demand, or tightening global inventories. Silver's long-term thesis rests on arithmetic imbalance rather than emotion. Supply growth lags demand expansion. Registered inventories decline. Paper claims multiply. Industrial consumption persists. Fiscal constraints limit sustained restrictive monetary policy. Inflationary forces remain embedded within structural transitions. The current price level should therefore be interpreted strategically rather than emotionally. It represents a moment shaped by liquidity conditions and tactical positioning, not definitive valuation equilibrium. As March approaches, delivery mechanics will test structural resilience. Regardless of short-term fluctuations, the physical realities beneath the futures market continue progressing. This period may ultimately be remembered not for the temporary flush to 75, but for exposing how tightly stretched the system has become. Liquidity manipulation, inventory contraction, industrial inevitability, and fiscal constraint converge simultaneously. Markets often appear stable immediately before structural adjustments unfold. Whether that adjustment develops gradually or abruptly cannot be predicted with certainty. What remains clear is that the forces underpinning silver's long-term trajectory have not weakened. They have intensified beneath the surface, waiting for price discovery to align with physical reality.